So good evening, everyone. Good afternoon, good morning, depending on when you're watching this video. As usual, I want to thank you for keeping it with us, but also to thank you for loving what we do. Today, I want to look at the taxation of individuals. Taxation of individuals, how individuals are taxed for the purposes of increasing the revenue in the country. So now we are going to now look at the forms of individuals for its purposes, and then the first category is the resident individual. So if you want to assess an individual, you first look at the residence status of that individual. If that individual is a resident individual, we are going to see what are the parameters that we look at while categorizing an individual. We are going to see in details. So now, when we want to assess an individual, we look at two forms of individuals. One, a resident individual, and two, a non-resident individual. Because the tax paid by a resident individual is quite different from that tax paid by a non-resident individual. So now, who is a resident for tax purposes? A resident individual is that individual who has a permanent home in Uganda. For the case of Uganda. So that is what the act is saying. If someone has a permanent home doesn't mean that someone should be having a permanent house. No. It means even if you have a glass such house, but it is known that that house is yours. If you have address, in other words, let me bring it in that form. So if you have address, then you are a resident individual. If we are assessing an individual, we will first look at that parameter. Do you have a permanent home in the country? If yes, then you are a resident individual. Number two, you may be there but without a permanent home in the country. We look at the second parameter. If you have been in the country for a period amounting in aggregate of 183 days, 183 in the country. Have you been in the country for more than 183 days? If yes, then you are assessed as a resident individual. Then three, if you have been in the country in the 2 preceding years of income for a period averaging to more than 122 days year of income. When I say a year of income, I mean a period of 12 months. So now, if you have been in the country in 2 consecutive years, this is what I mean. If you have been in the country in 2 consecutive years for a period that is above 122 days, then in that case, you're taxed or you are assessed as a resident individual. Then the fourth category is when you are an official or an employee of the government of Uganda, but posted abroad during their of income on a foreign mission. Examples of these people: you may be a diplomat of Uganda, maybe to a certain country, to US, to Nigeria, to Kenya. You are working on behalf of the government of Uganda. In that case, you become a resident individual for tax purposes. So now these are the parameters that we look at while assessing the residence status of an individual. So the question is, Who is a non-resident individual? Now we have looked at who a resident is. So the law says that a non-resident individual is an individual who is not a resident. A resident, I mean a non-resident is that individual who does not meet all of these conditions. One, he doesn't have a permanent home in the country. Two, he has not been in the country for more than 183 days in year of income. Then three, in 2 consecutive years of income, this individual has not been in the country for more than 120 days in year of income. Then four, he is neither an employee or an official, not an official of government of Uganda posted abroad during the year of income, purposely doing the work of the country. If an individual does not meet any of these, then we assess him as a non-resident individual. So now we are going to look at the tax rates of a resident individual. Now, before we go into that, a resident individual can be engaged in a business. So now, if this resident individual is engaged in a business, how do we arrive at the taxable income? We look at the financial statements, specifically the income statement prepared by this individual. Now, if this individual reported a profit, then you work out to get the chargeable income by getting the profit before tax. We add back all the non-allowable deductions or non-allowable expenditures. Now, non-allowable expenses are those expenses of private nature. Two, expenses that do not relate to the primary activities of the business. Then three, non-cash items, non-cash expenses. You could be having maybe a motor vehicle that you're using to conduct business, maybe in the marketing. You are an individual, you have a registered business, that you have the vehicle, let's assume, in your name. But this motor vehicle loses value by depreciation. So if it loses value and you're preparing the financial statements, that depreciation must be recognized in the income statement as an expense. Therefore, that one is a non-cash expense. Literally, you did not lose high, but the accounting policies, but also the international accounting standards say that depreciation must be recognized as an expense. So now what happens is that the tax officer or you, when you are assessing an individual, what you do, you don't allow. That is an unallowable expense. You add it back to the profit before tax. Two, loss on disposal. If maybe there was a disposal of a non-current asset and the net book value was lower than the disposal proceeds, that means that there is a gain on disposal. That gain on disposal in accounting terms, it is recognized under other incomes. But literally, there is no money that has been received, and therefore, no. If it is a loss, it becomes an expense. But it is a gain, it is recognized as income and reported under other incomes immediately after reporting the gross profit. So if it is a loss on disposal, meaning the disposal proceeds are lower than the net book value at the time of disposal, Then that loss on disposal is recognized in the income statement as an expense. And therefore, we are saying that is a non-cash expense and it must be added back if it was loss on disposal of a business asset. Now, other expenses that are non-allowable, expenses of private name. Maybe the owner of the business can take away money, maybe to cater for items or activities that are not related to the primary activities of the business. Those expenses are non-allowable, and therefore they must be added back. And expenses of the right. So those ones are added back to the profit before tax. Then after we raise the allowable reduction. If they are allowable reduction that are claimable, then you claim them and what you get is the chargeable income. Now, for an individual, you look at income from all the sources. You are a resident individual in Uganda. Look at maybe you could be having a boutique. You see how much are you getting from a boutique at the end of the year as a profit. So maybe you have another business. We also look at what you get from there and we bundle each and everything. Then after we charge tax using the tax rates of the resident individual. Now, if the chargeable income is exceeding 2.82 million, that is for a year of income, a period of 12 months, then you pay nil. So that is the threshold. In other words, if we are now assessing for the month ended, if and you got a figure, you got a profit that is below 235,000. In that case, you are below the threshold and therefore you shouldn't say anything. But if your income or if your profit is between 2.8 million to 4.02 million, that is if we are assessing for a year of income, then you pay 10% of the amount by which the chargeable income exceeds 2.82 millions. Let us take an example. Let us assume a figure here that maybe you got 4 million. 4 million is between 2.82 to 4.02. Let us assume that maybe you got 4 million in year of income. Now, if you are an individual and you are getting that, we get 10% times 4 million minus 2.82 million. So you first get the difference, 4 million minus 2.2 and then 2.82 million. Yeah. Here we are assuming that the chargeable income was 4 million. You get 4 million minus 2.82 million, what you get multiplied by 10%. That is the amount, or that is the tax an individual will pay at the end of the year. So now, what about if you are in this category? Your income or your chargeable income is exceeding 4.02, but it does not exceed the 4.92 million. In that case, you are charged 120,000. That is if we are assessing for a year, plus 20% times the chargeable income minus 4.02. That is how we assess individuals that are engaged bracket of the chargeable income. So we get 120,000 plus 20,000, I mean plus 20% times the chargeable income minus 4.02 million. So assuming that maybe the chargeable income was 4.5 million. So we would get 120,000 plus 20% times 4.5 million minus 4.02 million. What we get is the amount of tax that will be payable at the end of the year. So here I had to put these figures in the bracket here to show you that in case you want to compute for the maths, these are the figures per month. But now, if you were computing for their ended, the figures are here. Let me paint them another color such that you can get the distinction between the two figures. Let me put it in that color code. So that is if maybe the chargeable income of an individual is in that bracket. So now another category is when the chargeable income exceeds 4.02, but it does not exceed 4.9, 4.92. This category that is the last category. That one is the last category. What about if your chargeable income is exceeding 4.92 million or monthly 410,000? In that case, you are charged. In that case, you charge it. In that case, you charge 300,000 plus 20%. I mean 30% by which the chargeable income exceeds 4.92 million. So if that is the category, in that case, that is how we charge. The 300,000 plus 30% by which the chargeable income exceeds that is for the case of the year. That is for the case of the year. Now, but what about if you were getting the amount that is above 120 million? 120 million. In that case, an additional 10% is charged on the amount by which the chargeable income exceeds 120 million. That is if you're earning 10 million per month. If your chargeable income is 10 million and above for a period of 1 month, then you will charge the additional 10% by which the chargeable income exceeds 10%. Now let us look at taxation of non-resident individuals. These are individuals that are non-resident or that are not resident individuals or that do not meet the criteria or the conditions for one to be called a resident individual. For the case of Uganda, and for the purposes of taxation. So now we are going to specifically look at the tax rates for non-resident, and I want you to be vigilant here so that you can mark the difference, not exceeding 4.02. In that case, you pay 10%. 10%. So below that, groceries 35, between 235 to 335, you pay 10%. Then exceeding that, 335 for a month, but not exceeding 410. You can now see this figure is a bit big. For the resident individual, we are saying you simply get 120,000. Remember this. Okay? But here we are saying is 402,000 plus 20% of the amount by which the chargeable income exceeds 4.02 million. So assuming here the chargeable income is 4.5 million, we would get 402,000 if we are assessing for a year. Then we add we add 20% times 4.5 million minus 4.02 million. So in that case, we would get the tax payable if the chargeable income is 4.5 million. Now, if the chargeable income exceeds 4.92 million, 582,000 plus 30% by which the chargeable income exceeds 4.92 million. That is when we are assessing for the year. And the figures in the brackets, that is when we are looking at a month. So now, if for example here, let's assume that maybe a person is earning 9 million, because 9 million is above 9.42 million. So here we would get for the year, we shall get 582,000 plus 30% of the amount. Let us do it here. Here we are saying that you get this figure. We are assuming that our chargeable income is the now we get that figure plus 30% times the chargeable income. Our chargeable income we said 9 million. By which chargeable income exceeds 4.92. 4.92. So here what we get now becomes the tax payable. So there you work it out. First you deal with 30% times this difference, and then you add back this figure to get the tax payable for the year ended. But if this non-resident individual is earning about 10 million in a month or above 120, then the additional 10% is charged also on the amount by which the taxable income exceeds 120 millions. So that is how we tax individuals. A resident individual and the non-resident individuals. So, I beg to end here. Is I really want to implore you to subscribe to our channel, such that you can already be notified when we have posted a video for educational purposes, but also it help you comply with the tax authorities. Allow me to say thank you for watching our videos, but also liking what we do. At Finland Business Consultancy, we are offering a lot of services. You could be there and you are in need of tax consultant services. You have issues. Let's assume you want to file returns, income tax, VAT tax returns, maybe you need an instant tax expense certificate. Maybe you want to do some transfers such that the data can be reconciled. Maybe you want some tax training. You want to understand how all these are done. But also we have other services like we register companies and business names. We offer CP and HD tutorials. We do financial reporting and analysis. And you are having issues with the preparation of financial statements. But also you have them, but you cannot analyze them. We are also offering a lot of services. You need some accounts audits. You need bookkeeping services. You need financial reports. We are offering a lot of services. Feel free to contact us in the comment section. We shall respond very fast so that we can help each other. Thank you for watching our video and may God bless you.